Well, at Under the Radar Report, we're lucky to have two very experienced portfolio managers, and what they've shown over time is that portfolio management can reduce your stock-specific risk. So small caps are very volatile. Like even Telstra, as we've seen in the past 6 months, has come off 25%. So equities per se are a volatile vehicle. But with portfolio management, you're getting diversification, so you're reducing that stock-specific risk, and you're getting the return from, I guess, investing in a lot of different companies. Because it's been a market with low interest rates, there's been a lot of stock, like a number of stocks that have gone really well. So people's portfolio weightings have naturally sort of increased towards, say, more speculative stocks that don't rely on dividends. I think it's important to be taking profits in those sort of stocks, and to be looking at your portfolio every day, saying, should I buy this? Would I buy this stock today? So it means that you can't just set and forget. You have to look at your stocks very closely. On the other hand, as always occurs, some stocks have underperformed. We don't believe in that. I think it's really a good thing to average down or to double down in your position and to keep buying. We think it's probably, often the best advice is just to hold that position, keep it in the bottom drawer, and then, over time, those stocks can come good. Diversification means a lot of things, because you can diversify by sector, you can diversify by industry, by balance sheet risk, but ultimately what we're trying to do in the small cap land is find stocks that are unappreciated and have big growth potential, or stocks that are turning around their operations, so whether it's balance sheet reconstruction or earnings reverting back to the norm. So we're trying to find these sort of stocks where there is a lot of volatility, and you're going to have stocks in different stages of the life cycle. So it means really having a portfolio where there isn't one industry specific risk. So you're not betting on your risk isn't so concentrated that the consequences for your portfolio could be disastrous. There's a couple of key differences between an individual investor and an institutional investor. One of those differences is that we're not trying to beat a benchmark. But having said that, those benchmarks can be important. So the ASX 200 has a lot of different industries in it, but as we know, banks and mining represent about 40% of it by market cap. Now that kind of concentration is just stupid for an individual investor, whereas a lot of institutional investors are sort of forced to have that kind of level of concentration in their portfolio. So what I'm saying is, you've got lots of different industries. You can look and see those different industries and mirror that industry concentration, mirror that industry diversification in your small cap portfolio. Well, dividends are extremely important, but it's not something you actually invest on the basis of as a small cap investor. They're more a byproduct of value. But having said that, dividends represent an important way of taking risk off the table. And I guess with a portfolio, in terms of diversification, it's important to have that income stream for when the markets are volatile. So in our latest issue, we actually have a pie chart of forecast income for the small cap portfolio, which is really worth reading, and it shows how important that dividend allocation to the portfolio is, and it also shows just how important some stocks are. And those stocks aren't often sexy stocks like Capral. It's not they produce aluminium products, but they're 50% of that company's cash, of the market capitalization is cash and they produce good operating cash flow. So we're very comfortable holding that stock. So it's important to have some of these sort of stocks that aren't sexy in your portfolio, but can produce the kind of returns no matter what the sort of state of the market is. One of our mottos at Under the Radar is invest cheap and be patient, and this is exactly a case of that. But sometimes even when you invest cheap, like you have to be really patient because the stock doesn't go your way. So we first invested in the stock at around $8, and it was underwater for a long time, going as low as I think $5, because it's not traded with much liquidity. So because it's 60% owned by the Tudor Hope brothers, who obviously have a vision, and at times I guess the stock market's a bit impatient with how that vision goes, but their vision was to transform their company from a telco reseller into sort of a data center based software as a service cloud operator, and that vision's come to fruition over a long period of time, and now that stock's $20, at which we're taking profits. So it just goes to show that really hanging in there can pay more than dividends. It can really boost your portfolio's returns. Performance has actually been very good in the small cap end of the portfolio. We've produced 23% annual returns on the dividend portfolios on average, and on the in the small cap portfolio over 6 or 7 years, we've actually produced double-digit returns, and that's like 50 percentage points better than the small odds index. The big blue chip value portfolio at the big end of town, that's hung in there extremely well, producing in sort of returns in line with the ASX 200, but it will really benefit from a recent takeover from APA. So when we calculate those returns next month, I think we'll be pleasantly surprised.